Perfect. I think we can go ahead and get started then. So just on behalf of all of us at Firstline Compliance, I just wanted to welcome everybody to today's webinar on improving your HMDA filing process. I'm going to turn it over here to Josh in just a minute, but before I do, I just wanted to go through some housekeeping items. Number one, we do want to hear from you. We want your questions. So if you have questions during the webinar, please type that into the Q&A section of Zoom. We'll try to work those in. If we can't, we will follow up with you afterwards. So no worries if we don't get to your questions. You'll hear from us. The other thing is when we close the webinar, there'll be a short survey. We'd love to get your feedback on how valuable the webinar was and if you have ideas for future webinars. So please do fill that out. And then finally, we are recording. So a recording link will go out to all the registrants probably tomorrow. So do please look for that. And I think with that, I'm going to turn it over to our president, Josh Weinberg. Josh, take it away.
Amazing. Thank you so much, Rachel. Appreciate the warm introduction. And thank you, everyone, for joining us today. It's a pleasure to be here to talk about one of, I think, many of our favorite subjects, HMDA, the Home Mortgage Disclosure Act. I'm Josh Weinberg. I'm the president of Firstline Compliance. And with me today, we're really lucky to have Melissa Kozicki and Kathleen Blanchard. I have put bios at the end of the slide deck, so I'm going to give the very short, abridged version here. When I've got questions about HMDA from the technology side, I ask Melissa. Truthfully, when I don't know the answer on HMDA, I ask Kathleen. So as we're putting together this webinar, I really wanted to focus on bringing you really the best and brightest insights as we get prepared for filing HMDA season. And so please help me welcome and thank Melissa and Kathleen, and we'll go ahead and get started. So today, basically what we're going to cover. We're going to look at the big picture. What are elements we need to think of at kind of the 50,000 foot view from the HMDA perspective? We all know the devil are in the details, so we're going to look at those detail devils. One of the most important questions are, well, we think we did it right, but if we didn't, what do we need to do? When and how do we refile? And we're going to do our best to leave some time at the end for questions. As you're asking questions, if there's something that we can address while we're going and it's topical, I'll try and bring it into the conversation. If it's something that I think might disrupt our flow, we'll save it to the end. And as Rachel said, if we don't have time to get to all the questions, we'll certainly follow up after the webinar. Finally, this is a special day. Melissa and I are both ill, and Kathleen recovering from a medical procedure. So if you see me blowing my nose, if you see the mutes, be gentle on us. We're really excited to be here and present to you, but forgive the nasally voice as we go. Okay, so let's go ahead and jump in. And Melissa, I'll turn it over to you to start on the big picture.
Sure. So Josh and Kathleen have heard me say this next part a million times over the last decade. You know, we worked as an industry on TRID, and then we worked on HMDA, and it was like whiplash, the difference between the rules. TRID is so prescriptive, and I hated it. And then HMDA came out, and it was really not that prescriptive. There's a ton of optionality within the rule, and I hated that too, right? It was just at that point, the Bureau couldn't win. And that's, I think, one of the challenges, the continuing challenges is that flexibility. And so we had asked on many occasions, we would ask the Bureau questions, and they would say something like, well, that is a choice you make, or that is a procedure you have to do as you operationalize the optionality. And they would constantly say, operationalize the optionality. And so I like to now repeat that. Because they're not wrong. They're choices that you have to make, and they have to be conscious decisions that are well documented. And I think this many years on, we take some of this for granted. But I wanted to chat about it just a little bit. Some of these, application date, right? I don't know that there is a right or wrong answer. The point is that you pick the answer, you pick the thing you want, you stick to it, you're consistent, right? And because application is defined in HMDA very differently than anywhere else. You know, it's an oral or written request that's made in accordance with your procedures, right? What are those procedures? Okay, well, what procedures? Most people use either TRID or ACOA application dates from what I've seen. I don't know of anyone that uses something other than those two. I've had people tell me that the Bureau absolutely prefers the TRID application date for HMDA. I've heard people tell me that they absolutely prefer the ACOA application date. I'm not aware of a preference. I don't know, Josh or Kathleen, if you are. I feel like both of those are viable options for your application date.
To me,
As long as it legally makes sense, within Reg B, then you're fine. So if you can back it up by looking at Reg B and saying, yeah, that's when this person requested credit from us, that's your date. And you don't make, I've had people try to make up a date for HMDA, a different application date. And I'm always telling them, you don't do that. It's, what are you calling it, an application date for Reg B, and which may be your TRID date, might be a little bit before or a little bit after. But you don't make up a new date for HMDA. HMDA, what you made me think of when you talked about how this was so different from TRID, the one mantra I'm always saying is HMDA is reporting. It's not telling you how to lend. It's telling you how to report what you already did.
Yep.
Yeah.
great points. I'll just add, and I know we'll talk about it here in a minute. As I think about the nuance between TRID application date and application date under HMDA and even under ECOA, is TRID's purpose for capturing the application date early, based on kind of the spirit or intent behind RESPA and TILA, to provide early estimates of accurate fees before the consumer has provided much personally identifying information to improve their ability to shop. HMDA and ECOA really are looking at the concept of a complete application and what happens once you've received that complete application. And I think that's the nuance that really separates those definitions of applications, is a creditor's ability to define what a complete application is for their purposes.
And what to do when you have an incomplete one. Yeah.
Yep. And Josh, I don't know if you want to flip the slide so that it's bigger. Like, I don't know if you can flip the display settings, like presenting on this or not. Someone made a comment in the chat. So that the slide's
thought
bigger.
we were full screen. I apologize.
No. I don't know if it's display settings.
Josh, if you want to go up to the display settings up there, see that with the little caret down?
That.
There you go. Either one of those should take care of it.
There you go. Sorry about that, folks.
Okay. Yeah, I didn't even notice. There we go. Now it's nice and big. Yeah, so that's, that's something that you make that decision and you stick with it. Credit decision is a really interesting one to me because it sounds like a no-brainer. So I'm going to, give you a couple examples of where it can be a head scratcher. And this is one that I see a lot in daily life. Do you, for instance, let your closer adjust the loan amount so that maybe it covers the payoff? I see that happen a lot. Maybe the borrower's approved for a range and you adjust the loan amount at closing. Okay, well, if you do that, then the LTV and DTI that you're sort of looking at on your screen isn't what you're going to report to HMDA, because it's not what was relied upon when you made your credit decision. There are several data elements within HMDA that are dependent on having been relied upon. And so you need to make that decision, right? Did that closer just make a credit decision? Or no, did they make a tweak to something within their parameters? You need to define that and understand that and really test your system, make sure your system understands what you're trying to do, right? Your system should be able to identify what was used in making a credit decision versus what might have gotten changed somewhere along the way. And you have to make that determination to make sure you're reporting those accurately. It's always disconcerting. I feel like sometimes people complain and they'll say, well, what I report to HMDA can't be different than what's in my system now. Well, it can be, right? Do you want it to be? But it can be. And you guys probably see a lot of examples of that as well. The other one is,
just to mention, I think it's also an interesting dynamic, because for things like credit decision, we go on what was relied on in making the credit decision. Whereas it comes to loan amount, especially on a file that's not originated, we're reporting the loan amount initially applied for.
Mhm.
And so I think that really gets to the importance of tracking in systems to make sure that we have consistent processes for reflecting the correct data at the correct point and when that transfers to the LAR data.
Yeah, absolutely. And I think even credit decision earlier in the process can be hinky, right? Is a credit decision for you a clear to close, or is it an approval? Right? At what point? And it matters because you have to make sure that your system is capturing the data as of that credit decision, right? There's generally only one credit decision on a loan. So you want to make sure that you have that defined both in your written policies and within your system. So that's something that you really gotta work on defining. Action taken. I know this is another one that sounds a little bit like a no-brainer, but there's actually some optionality in this. And so, for instance, you could have, I'm sorry, the action taken date. You can have, like, on a denial, for instance, it could be the date the decision was made or the action was taken. It could also be the date that's on the form, right? It's a minor distinction, but again, you have to have that in your policies if you're going to backtrack to it, and especially during an audit. If I'm an underwriter and I make the decision today, what if I don't send the disclosure, the adverse action out until tomorrow? Or what if somebody else's job is to send that out and it's tomorrow, right? It can be either one, but a lot of people, I think, miss this nuance in their written policies and procedures.
That was a point I was going to emphasize again. Written policy, both on the denied side for action taken, on originated as well. Are you using the consummation closing date or the funding date? Both are technically permissible. We just need to decide which one we're going to use and use it consistently and then document that choice in policy.
Yep. Yeah, I mean, these are just a few examples, but there are more. There's a lot more optionality in there. It's not a bad idea to kind of go back and just sort of skip. HMDA is not a terribly confusing rule, right? Like reading this one, if you read, the data points, it's not baffling. It's not like reading Truth in Lending. Let's just say that, right? You can sit for an afternoon and skim and see those options kind of jumping out at you, especially after all these years. And then again, just having
There's a
policies.
logic to HMDA.
Yeah. Yep.
There's a true logic to it, and it's a very linear way of
I would say it's
thinking.
linear. Yes, it's not like
Very,
QM that
yeah.
jumps all over the place. HMDA's
No.
just boom, boom, boom.
No.
It's a good read.
Yeah.
Maybe not a beach
Yeah.
read, but it's not a bad read for an afternoon.
No,
and then
it's
you can
not.
kind
It's
of
not.
evaluate.
Yeah. Yeah.
And then these last ones are just, just to make sure again that they're in your policies and procedures. Reasons for denial, you're going to print up, you're going to report up to 4. What's your policy when there's more than 4, right? 4 primary reasons. So you need to have a policy of what you're going to do. Which ones are you going to report when there's more than 4? Same as with race and ethnicity. You can report up to 5. There was a lot of conversation before HMDA went into effect on what to do if the consumer has chosen more than 5 of the race and ethnicity. How should we report what? I think the majority of folks have just taken it top to bottom, like the form, whatever the 5 are,
Yep.
the first 5, that's what they're going to report. You guys, I was going to ask you, you're shaking your head or nodding your head. Does that mean that's what you've seen too? Just
Yeah. Yeah.
top to bottom?
They defaulted to just go in order.
Yep. Okay.
Do the majors, and if you have room, you go back and go in order in the minor ones. And that seems to be what most are doing, because it's something you can point to.
Yep.
You can
And
say
that was the
that's why
thing.
we did it. Yeah.
There was so much conversation about really complicated stuff I didn't want anything to do with about, well, but what if what if we need to shore up some of our minorities, and so we could pick those out, and it just sounded ugly. So top to bottom it makes the most sense. But again, make sure that you have this documented. And all of this, including all of the options that we haven't talked about here, really, communication. Your system admin really is critical to your HMDA, because this is such an LOS intense, a data intense rule. It's not just disclosures, right? I mean, it's not like other rules don't need your system, but this one doesn't have like a bunch of disclosures that you rely upon. It's all that data that's in the system. And then as you've heard, it's picking the right piece of data at the right time to report to HMDA. So your staff, but especially your system admin, your LOS manager, they really have to have that written policy and procedure to refer to, so that they can make sure that they've got the system set up correctly. So communication, training, policies and procedures, and really make sure that you include your admin staff. That's really key for HMDA.
One thing I thought of as you were going through this, Melissa, and Josh had mentioned about, what do you report when you're saying, okay, this was the application date, this is the amount that was applied for. The one thing that comes up a lot is if that amount was amended, if the customer asked to have it changed. And it's similar to the counteroffer. And this comes up even with the counteroffer, where it says if they ended up not accepting, they just wandered away or said no thanks, and you go back to that was applied for. But if they amended what they applied for, you go back to what they amended it to, because you had a different legal amount applied for. And I've had people say to me, well, here's what our system's doing. It's issuing a denial letter based on the amendment, but for the other stuff, it's coming out and going back to the original application. Well, you can't do that. And that just makes no sense. I say to them, then go talk, you've got your system set up wrong then. You're not telling it what to put where in terms of, mapping your fields and that type of thing. Because we even, I think our vendor group, we talked to the CFPB about that, and they said, you go back to what was the last amount being considered according to the applicant, not because your lender was spinning scenarios, which
Right.
they do. We all know they do that. But what was the amount the customer said, I'd like to increase that amount, I'd like to decrease that amount. That's the amount that was under consideration. And I always use the denial letter as an example. I go, how confused would your customer be if they changed that application from 100,000 to 75, and you sent them a letter that said, we're denying you for an application for 100,000, and they go, whoa, wait, I had changed that. I applied for 75. So now you're telling me I've turned down for 100. What about my 75? You're going to get it all confused. You look at what was the amount that it had been amended to. That's an amended application, and stick with that. And I find a lot of confusion around that.
I think those are really good points. And to me, it really kind of crystallizes the importance of systems and consistency. For lender shops where I've seen the most effective and efficient HMDA compliance management systems, there has been a significant amount of system automation. The analogy I use are bumper lanes for the bowling alleys. I truly believe almost all of our MLOs really do want to do it the right way and give you a complete application with all the data we need to be able to file HMDA. If we're expecting our MLOs to understand the intricacies of HMDA, we've lost before we've started. Yeah. So it's really incumbent upon us compliance officers to work with our system admins to implement processes and the way the system is built to provide that workflow or that automation to keep people on track. Reasons for denial. Have we done things like mapping between the statement of denial to the denial reasons in HMDA? The race and ethnicity. Have we programmed or used business rules to identify the selection and population? That communication that Melissa talked about is fundamentally required because I'll be honest, while I've spent a lot of time in technology, I am not a system admin. And while system admins I've worked with have often been very skilled in compliance, they are not compliance officers. So the blending of the two skill sets and the melding of the information is really critically important for successful implementation at lenders. Let's jump to the next slide.
And this goes a little bit to what we were leading up to, a COA versus HMDA, right? They're very similar. There's some similarities, but they're not the same rules. So you've got in the upper right here, you have 8 HMDA dispositions that you're going to end up with, right? Maybe you don't buy loans, maybe you don't have a pre-approval program, but really there's 8 options. And where you can sometimes get misaligned is when you need to do your adverse action. So you want to make sure that you sort of understand what you're doing with that, right? You have, for instance, that you understand what each of these means. Let's start there, because I think some people get a little bit confused on some of the options. So approved, not accepted, for instance. Approved, not accepted is very specifically that you have approved the loan. A credit decision's been made, nothing but customary conditions or closing conditions is left. And then the applicant ends up not doing anything with it, right? It's not a withdrawal. The difference is a withdrawal. You can have a credit decision or not on a withdrawal, but a withdrawal is an expressly the consumer expressly withdraws. They do something. There's some action on the consumer's part that says, I'm not going to go forward with this, right? As opposed to approved, not accepted, that's really where the consumer's blown you off, right? It's where the consumer has not responded to your approval. And so it's important, I think, to understand the difference between those two, because you're not going to send an adverse action out. I say adverse action, but it's a statement of denial, termination or change. You're not going to send that out for an approved, not accepted, right? You've already sent them their approval because you've approved it subject to customary conditions. So it's important to understand that.
Because this is an area we get a ton of questions on, and we tend to see a lot of errors in this area. It's easier, I think, in kind of more common origination terms. If you've cleared to close the loan and the borrower ends up not proceeding, that's approved, not accepted. If you have conditionally approved the loan, so there are conditions, but the underwriter has not cleared those conditions, then credit conditions still remain. So the loan is not officially approved. Right. Therefore, it cannot be approved, not accepted. So I really try and draw that line. And again, use some of those system data points. Is clear to close the right piece? Is credit credit approved? Some indication within the system to really demarcate all of our credit capacity conditions have been cleared. Anything going forward will be approved, not accepted. If those credit conditions have not been cleared, then it would be withdrawn. So it's still the consumer in both cases, the consumer really has to express, hey, I'm not going to move forward. I think it's really that tension or that nuance. Has a credit decision been completed?
Mm-hmm. No, it's a great way to say it. And I think with that, then you also get closed for incompleteness is sort of another decision point, right? There is a HMDA disposition of file closed for incompleteness. If you were to send the consumer the notice of incompleteness along with their adverse action, which I think is the most economical thing to do, is just get it all out at once. So if you do that,
you mean the notice of incompleteness?
The notice of incompleteness with all of the information that's missing and everything you need for for your final statement. Then if you've done that, if you've provided the appropriate disclosures under a COA, you can report it in HMDA as either denied or closed for incompleteness. So there's another choice there, and I don't know which route people choose to take most often. But you do have that option. You'll notice that under HMDA, one of the reasons for denied is file incomplete, right? Or you can disposition it as closed for incompleteness. So it's a choice. I don't personally have a preference. I don't know, Kathleen or Josh, if you guys advise anything in particular.
I have a preference coming from a lending side, a management side, that the first thing to remember is if you want to use closed for incompleteness, Action Code 5, you have to have issued a compliant written notice of incomplete application. Otherwise, you've just done an oral one and you cannot close for incompleteness. You would have to deny for incompleteness. And what I always tell people is, if you've gone to the trouble, which I always encourage and always used when I was still involved in lending, a written notice of incompleteness, because you're not going to inflate your denials on your LAR. You're going to be able to report them as closed for incompleteness and not denied, because for fair lending and everything, the higher your denials, you're waving a red flag. You're waving a red flag. And the Bureau even, they've made some of the choices we have in HMDA is because the Bureau got questions from people saying, they told me, they said, we got a lot on that subject. And we finally threw up our hands and said, pick one. They've got a lot of institutions saying, well, what if we issued a written notice of incompleteness and then we issued a denial anyway? Well, what I tell my customers is, why would you do that? Well, don't do that. You're inflating your denials. We get very few breaks in the regulatory world. They're giving us a break there and saying, you don't need to report that as a denial. Report it as closed for incompleteness. So don't issue a denial. Number one, you're doing more work than you have to. So
Right.
don't do more work. From an efficiency point of view, it's better. And from a regulatory point of view, you're not inflating your denials. So it's in your favor to do a written notice of incompleteness, and then that clock stops. That clock stops. The Reg B clock stops, and it doesn't start up again until you got everything from that letter, and technically doesn't start up again even till you got everything from third parties, your appraisals and everything. And then you've got a completed application and a new clock stops. So I highly encourage a written notice of incompleteness, and then just close it for incompleteness, Action Code 5, and don't confuse the whole thing by then issuing a denial and then reporting it as denied. Well, then why did you do the other thing? You're contradicting yourself. So my choice, I'm a big proponent of the written notice of incompleteness, and then if it comes to pass, close it for incompleteness. It's better for the institution. And like I said, we don't get that many breaks. When you get one, grab it and run with it.
Three quick points. I wholeheartedly agree. When I think about it from the fair lending perspective, and I'm looking for consistency in credit decisions, I don't like seeing some files denied for being incomplete and some files closed for incompleteness. It gives me the question is, why was there a variation in process? So that's the first point. The second point, and this I think is a nuanced point to tease out between ECOA and HMDA. We talked about both regs often leveraging the same definition of application and the notion of a complete application. However, there's a nuance. ECOA says if we've denied a loan, even if it's not yet a complete application, the act of denying it makes it a complete application.
Right.
And so that triggers the requirement to issue the adverse action notice. And if you've pulled credit, that's similar for FCRA. That nuance is I've now issued the denial notice to meet my ECOA and FCRA requirements, but I'm still not reporting that loan for HMDA because it has not met my definition of complete application under HMDA. So I think that's an important piece. And then to combine those two together, if there's a scenario where we've gotten TRID 6, we have not yet gotten all the information for our HMDA ECOA definition of application, what are we to do? In my opinion, if we can't, first ask the borrower. That's the first thing. Reach out to them, see if we can get the information. If we can't, that's to me a circumstance that I'd be okay denying for incomplete. Because I personally would not want to send TRID disclosures with what I call dummy data. In order to get the disclosures out, I'm going to have to populate data into my LOS that the consumer has not given me. That's going to be messy and difficult to explain from a data analysis. So if it's a incomplete application from the HMDA perspective, but I don't have enough information to make it complete, that's a scenario where I'm more comfortable denying for incomplete, especially to Kathleen's point, we're not reporting it under HMDA anyway.
Yeah, and the nice thing is, what was I going to say when we're with HMDA? Oh, the important thing, not the nice thing. Well, it is a nice thing if you do it correctly. Define when you've got an application. You've already got an application. Define when it becomes HMDA reportable. When do you have enough information? And it's going to have to be enough information that you can fill out the LAR. So you have to look at that. If you don't have enough information to fill out the LAR, well, then you sure better define your applications to be not that scenario. Because one thing that a lot of people will leave out, and the Bureau built a funny edit in there because of this situation. When you get to loan amount, and for loan amount, we've had for many, many years, even in the old HMDA, where you didn't report anything that was smaller than $500. That was because it rounded to zero when, I don't remember, are we rounding now or not? But when it rounded to zero, it would round away. So you never had zero. But with the new HMDA and the Bureau actually trying to accommodate people, trying to accommodate institutions, there's an edit validity edit 617 that actually says your loan amount could be zero. And the reason it says that, I contacted Washington and said, well, wait a minute, this is a little odd. And I said, let me tell you my theory of why you did that. And I told them, and they said, that's exactly right. You're understanding what people are doing. What it is, because people weren't defining their application or they were defining it to be everything, and they didn't have a loan amount, they didn't know what to put on the LAR, and they hadn't defined their HMDA application, so they had to report it because of their own processes. So the Bureau said, fine, in those cases where there was early activity, that your application was denied, withdrawn, whatever, we will allow you to put zero on the LAR for loan amount. Otherwise, when you're far enough along, you can never put zero. It's got to be the minimum of 500. But that was their reason, because again, they said we were inundated with questions from people because they hadn't properly defined what is a HMDA reportable application. And you start with your Reg B application and say, at what point is this going to become HMDA reportable? Doesn't give you a new application date. It just triggers the reg. Suddenly that application needs to be considered. So you need it, if you think out the whole thing and read those comments and everything, as Melissa said, there's a logic to it, and you can understand what they're telling you to do. But there's always a reason behind why the Bureau's doing something. They're not willy-nilly doing things. So that's an important one, though, to understand. Define when you've got a HMDA reportable application, because it will make your life a lot easier.
Excellent. Great conversation. I'm going to move us to the next slide just so we keep us moving and keeping track of time.
Yep. So this one, we're not going to go, or I wasn't going to go into a ton of detail. The moral of this slide is know what year you're in, right? HMDA cares about the year something happened. And so whatever it is that you're looking at, if you're choosing to reinstate an application, so let's say it's closed for incompleteness or something happens in December, borrower comes back in January, you're gonna have to start a new app because you have this disposition for that previous year. So when you reinstate an application, you should generally only do it within the year that you closed it out. You could have a loan on a LAR twice, right? It could be on there once because you closed it, once because you had to repurchase it. Or because you did repurchase it. I've known organizations that have both a retail and wholesale wing, and so a loan has come across. Post-consummation CDs, which can impact your rate spread, those kinds of things. If they are coming in January, right, then they don't affect us. It is what it was for the reporting year. So this is just sort of a reminder. There's a few different things in there. This is both not so much a procedural thing, I think an awareness thing. It should be in your procedures, because I think people forget and they get confused on these points sometimes. And so it's good if they're in your procedures, that you, especially the reinstated applications, you should have a policy on. Then it's good because your staff goes and that's where they look for an explanation or when they need information.
And I'll just repeat that point of policy, high level understanding of the position and definitions, procedures, how we actually do it, and then system implementation to reinforce the procedures that you've developed. if the system settings are in place to manage between calendar years, the system can help reinforce or prevent overwriting data after that calendar year has changed. Great. Okay, I think we've covered our big picture pretty well. Why don't we start getting into where the devil makes sense? Kathleen, I'll start
Okay.
with you.
Okay, so I'll start on temporary financing. This one really confuses people, and it's actually very, very straightforward. There's only two types of temporary financing. One of them is when you've got a loan that is going to be replaced by separate permanent financing. A new note is going to replace that initial note. And the common example is construction loans. They're the most common temporary financing. So, and this is if you've got the two close ones. Because if you have a single close, you only had one closing. You're not going to close again. So you have your construction note, and then you've got your permanent financing, and it's a separate note. That initial note, the construction portion, is excluded from HMDA. It's temporary. If you have a loan that is to buy a property, fix it up, and sell it, it actually tells you in the 1003.3, in those exclusions, it tells you those are not excluded. The flip kind of loans that we see commonly, they are short. They're not temporary. And sometimes maybe they're not even that short. They might be a couple years, but they are not temporary just because they're going to buy a property. Maybe it is going to be real short. They're just going to paint it and then sell it and flip it. That is not temporary. If you look up at the top, it defines temporary, and it says you have to have another note totally satisfying and replacing that initial note. Okay. And you don't have that with a flip. You have a note that funded it. They bought the property, they fixed it up, they sold it. Okay. So that's not temporary. Did I make that move or did you make that move? Oh, okay. Sorry. Anyway, so the other type of, and that's it for temporary. If your loan, if you have a loan that was done and then it got modified to perm, it cannot be temporary because there's not a separate note satisfying and replacing it. So if you've bounced yourself right out of the possibility of temporary financing if you're modifying to perm. And I see that a lot, which is, I always found that kind of strange. But it is possible to do with the proper documentation, hopefully attorney prepared, and you're going to modify that initial note. Well, then you don't have a separate note coming in, so it can't possibly be temporary. So just, you need that second note for temporary. The other kind is the builder exclusion, which will never have a second note because they're selling those properties and they're getting financing. They're building a dwelling or dwellings, and then they're selling it, and repayment is through the sale. Those are excluded because it just doesn't make sense to report them. They will be picked up when someone buys that home and theoretically finances it, and then that property gets into the stream of its HMDA life of being reported as a purchase. But the builder loan, and that's the bottom, down the bottom list of the exclusions. That's the second type of temporary, but that's it. Anything else is not temporary.
Excellent.
Okay.
I'm going to jump on subject property address. So as a compliance officer, particularly if you're on the West Coast, it's about 6:30 in the morning, and you get an email from CFPB saying, we've reviewed your LAR. You have significant issues with subject property address. You need to review and refile. Few things can get a compliance officer more concerned or panicked than that type of email. So this was, I believe, in May of 23, CFPB sent this notice to say, our ops team has reviewed LARs from 2020, 2021, and 2022, and we see widespread errors related to the reporting of subject property address. Couple things to do here. My first recommendation, when you have your LAR export it as an Excel or CSV, sort your subject property address lowest to highest. What that will do was identify subject property addresses with no number. It also should identify 123 Main Street or 000. The nuance here is the Bureau was very clear in their expectations about when subject property address should be reported as NA versus when it should actually be included. And the short version is, if you don't have the specific property address, then property address should be reported NA. However, we still need to geocode, and the geocoding is expected to be accurate to the best we can. So we're new construction. We don't have a subject property address. We have lot and block number. If we have no subject property address, we must put NA. However, we have the lot and block and additional information where we can do geocoding, so do that. When there are multiple units, there's guidance on which unit to report, and it's typically the one that was the anchor of the credit being provided. So if you have a 4-unit property and one of them is the main collateral for the loan, that would be the one that you would report. Just highly recommend go back and look at the Bureau's guidance, reach out if we can help. Subject property address was one that caught a lot of attention, but I think should be relatively easy to self-correct.
Yep.
Kathleen, how about rate set date?
Okay. On that one, I just wanted to point out the one item that trips people up, and it's buried in the comments, which, as you all know, you need to read those comments to know what to do. The reg itself doesn't give you the data on exactly what to do. You got to read the comment that goes with it. And I find a lot of people still at this date aren't familiar with the comments. Of course, we have new people by this point. But anyway, the point I wanted to bring out was the part about exercising discretion. It's in the subsection under rate set date, under rate lock agreement, but it actually applies to the whole concept, where it tells you the relevant date that you're going to report is the date you exercise discretion. That means, did you make a decision? That's your exercising discretion. So if, let's say you have a loan and you did have a rate lock agreement, or you just informally locked a rate for them, and that time period went by, well, do you have it set up that if, say, closing is within 15 days, we will always honor that date and we go to closing for every single customer? That's what we do. Then you didn't exercise discretion. You've got a policy driving that. And so you're going to go with the original date. If you've got to go like to a pricing date desk or a senior lender or something and say, here's what happened, how do we handle this deal? Then a decision is being made, discretion is being exercised. And that's the date you're going to report, that new date that a new decision was made. So you've got those two scenarios, not exercising discretion and exercising discretion. And then when you follow what it says in the comments for rate locks and reporting dates, it makes it easier if you get that concept. That's how that works. Did you decide something, or do you have a way that you automatically say, for all these loans that it was within X days of closing, we just go to closing with that rate? That's great. Then no decision was necessary. Stick with the original date.
Yeah, I really like that perspective.
Yeah.
I was going to say too, again, remember the connection between the rate set date and things like rate spread in comparison to APOR.
Yes.
Both when we have increasing rate environments and decreasing rate environments, that change in the rate set date or the last rate set date can have a pretty significant impact to those.
It sure can. Yes. Yeah.
Great.
And I'd throw in on that too. We have seen many times where a loan does not get locked by policy. Maybe I don't lock my second liens. I just honor what we quoted, or we even have some I've seen where they're first lien. So, there are some loans that just don't get locked. And so that's sort of both the policy. And I would think that in that case, to me, it gets set at closing, since that's when it becomes real. Would you agree with that?
That depends, Melissa, because I kind of look at it as, what did you promise that customer? If you go and change your mind, are they going to sue you? Then you promised them a rate. So you have to me, you have to think about it. And there's probably no, 100% way to do it. But I look at it as, you said to them, that's your rate. And I've known some who they report their HELOCs, and their HELOCs are all as of application date. Now that's changing as the rate scenario has changed, the rate environment has changed. But they'll say, it's the date you applied, we tell you that's your rate. Well, how do you back out of that? You've told them that rate, you've promised them a rate. And coming from the lending side and the credit policy side, and experiencing lender liability lawsuits over rates because somebody changed something that they weren't supposed to, I would be hesitant to change a rate that an employee specifically promised. They're
Right, but if you
representing the
don't change
institution.
if you don't change it, you're saying you can, from a policy standpoint, you might choose to use the application date.
The date you promised it. Yeah. What's
Gotcha.
the date you promised it? Yeah. Yeah.
Great. I'm looking at the time. I'm loving this conversation, but I think I got to speed us up a little bit. So I'm going to
Okay,
hit
yep.
blanks, NA, and zeros, and then the demographic information. And
Okay.
Melissa, feel free on the blanks, NA, and zero, because I know you've done a ton of work there. To me, the one thing I mentioned, this is another one: export your data in Excel, filter for blanks. There are very few fields that should be blank. Usually there's an NA, maybe a zero, or a code that would reflect NA or zero. Very few fields should be blank. So if you see blank, something to look at. Real quickly, anything to chime in, Melissa?
No, just double check. I would say consult the FIG. Maybe consult the FIG before you call your technology provider, because it can trip you up. Like even I have to look at it because it is so variable which of these things it is, NA or code and things like that. But
And just for us non-compliance geeks on the call, FIG is not a delicious fruit. It's the final information guide. Maybe it's both.
Yeah.
Demographic information. Do not wish to furnish versus information not provided. I raise this here because of the deviation between the IRLA, which the borrower says, I don't wish to furnish, versus HMDA, which requires us to report information not provided. I think that's another good system setting, but also really pulls through the nuance or the tension between the method of application. If I'm in person taking the application and I'm filling out the demographic information, even though the borrower tells me they don't want to based on visual observation or surname, I'm going to have to provide that DI, even if the borrower said, I don't wish to furnish. Whereas if it's telephone or internet or non-face-to-face, if the borrower doesn't provide it, let's say especially on an internet application, if the information comes across blank, we're going to need a process to indicate for the LAR information not provided. Kathleen, let me pass it back to you for transitory dwellings.
Okay, and I'll keep it snappy. Transitory, the main thing I wanted to point out, because I get tons of questions on this, is when is a dwelling transitory? Well, if someone's living in that home, whether they're a tenant or the owner, it is not transitory. Is it the place they return to when they go away? It's not transitory. That's their home. And normally it will be their legal dwelling, whatever they've determined for tax reasons and everything, that it's their permanent residence. So that's it. So if it's, but you have to be careful, because for HMDA, there's a difference from Reg Z and even from the IRS stuff, which Reg Z reflects. If it's say a beach house or a mountain house, but the owner, not the owner, the applicant or borrower, which may or may not be the owner for HMDA, uses it for any period of time. It could be 3 days. HMDA has no minimum. That changes from a transitory dwelling that's rented out all the time to vacationers to a secondary home. That personal use changes it from that. So you have to pay close attention to that. And that is different from Z, which gets into 14 days and all that kind of stuff. So you need to understand those differences. But that's the big thing on transitory. It's not someone's home that they live in and come back to when they go away. It's something being rented out for vacations and that kind of thing, or rooming houses, just short-term, turnover kinds of things. It's someone who maybe they don't have a home, but they're going to go to another transitory. So you have to understand that nuance.
Excellent. Repurchase loans. We touched on this some. I think important to keep track of the year and remember whether we purchased a loan or were required to repurchase a loan, both of those are considered a purchase under HMDA, and repurchases would need to be reported. And as Melissa mentioned, that would result in the same ULI, the same loan record, being reported twice on the same LAR. What will differentiate is the action taking code. We would see the originated for the original, and then on the purchased, we would not be reporting the origination data because we're reporting it as a purchase loan and the appropriate NAs filled. Credit score. This is one where we see a lot of questions, but also errors. What I would say is focus some on when is credit score actually NA, and the nuance between credit score being reported for the borrower as NA and then the requirement to report for the co-borrower as NA, even if there's no co-borrower or co-applicant. So credit scores, I think, is another nuance point. Melissa or Kathleen, anything to mention there? Otherwise, Kathleen will push it back to you for signers as entities, as individuals.
I don't think so.
I get
It
a
is a
ton of
tricky
questions
topic.
on it because there are two options within HMDA, right? Which I call loan level or individual level credit scores. The wording within HMDA can be a little confusing. I don't know many people who let me say it differently. Most financial institutions pull credit, get 2 or 3 credit scores on every single borrower, look at them all, and based on some formula, maybe, lowest, mid, whatever, that's the score. That's the representative loan score. That's how most underwriting decisions are made, is on that loan level representative score. And then people get confused because, as you say, Josh, then there's not going to be something in the co-borrower position. There won't be a credit score in the co-borrower's position of the LAR, or they'll call and say, oh, but that's the wrong one. That's the co-borrower's credit score in that position. So we don't have to go through all that nuance now as we're running out of time, but I think you should be aware, when you're reviewing your policies and procedures and looking at what you do, that those are the two options within HMDA. You probably just use the former, and so understand how that's supposed to report.
Yeah.
It's the thing we get probably the most frequent questions on from a technology side.
Yep. So you want me to jump onto signers real quick?
Yes, please.
Okay, the reason I listed this is because I find there's a lot of confusion for some people, and maybe it's because they're newer to the lending world, they're newer to HMDA, but they're trying to understand who's the borrower that they're looking at for different things on the LAR. Who are they reporting on? And they get confused between someone. I always use myself as an example. I'm an owner of Key Compliance Services. Well, then when I sign for Key Compliance Services, I sign my name, but I'm signing for the LLC because an LLC can't pick up a pen and sign a line. I have to sign it. But then if I'm also taking individual responsibility and not as a guarantor, I also need to sign that note again as an individual borrower. And on the note, it's either going to say, you might sign one time and it will say, for Key Compliance Services and individually, it'll say that signature has two meanings. I'm obligating the LLC and I'm obligating myself. Or it can be the two lines, one for the LLC, one for me. But just because it says Kathleen Blanchard under the Key Compliance Services doesn't make Kathleen Blanchard a borrower. And I like to tell people, go talk to if you're lucky enough to have legal, go talk to legal or go talk to your senior lenders. And they generally train lending people on that subject. Ask them to walk you through that, because if you get it wrong when you're documenting, because I get documentation questions too, you're really messed up if you get it wrong if you're documenting. But have one of those people that are really expert in this walk you through it so that you understand, and they can give you, maybe they've even got handouts already ready and you could use. But it's an important thing to understand of who's in what position and what does that signature mean.
Okay, we're going for speed round. Kathleen, can you walk us through refiling and resubmission in about 3 minutes?
Okay, yeah, I think I can, because I made some notes on that to try to so I know I had needed some specifics to tell people. You're going to look at the LARs that you wanted. The document you want is the HMDA exam procedures. The FFIEC HMDA exam procedures has this detail, okay? And it gets into the errors, how many errors. It gets into when do you trigger resubmission. It covers all of that, and it's got some nice little charts in there and everything. And it can depend on the entity size, the number of LAR records, which is the transactions on your LAR, okay? The applications and the loans on that LAR. You're going to look at that, and this ties into, is there an error threshold? Well, there is a threshold, but people keep throwing that 10% around that's from like centuries ago, and that's not the number anymore unless you've got a really small LAR, and it just coincidentally is the percentage. But when you see the charts in the FFIEC HMDA exam procedures, you will see that if your LAR is up to 500 transactions, you get 3 errors in a field and you've triggered resubmission. It's not very forgiving. And that happens to be, when you look at the way they work it out and show you how they calculate the percentage, that happens to come out to a 10%. Anything over 500 on the LAR, no matter how big that LAR gets, 4 errors in a field. So if you've got a single field that you've got errors in and you've got 4, you're going to have to resubmit. And I know some large banks were flipping out in the very beginning, well, before they got used to that and just realized they had to accept it. Because they'd have, this huge LAR with, thousands and thousands and thousands of transactions, and they'd have 4 mistakes, and they were told, well, you got to resubmit that. And they'd be like, oh my God, this is crazy. But that's how it is. So you need to look at the chart in there, and that's on page 44 of that document. I would print that document out or save it on your desktop or something so that you can just go to it, because it's very helpful. Then it also tells you about your data collection timelines. And the deadline is always 3 years from the year end that you submitted for. So this year's 2024 resubmission deadline for you resubmitting to correct things is going to be December 31st, 2027. Okay. So this year, 2024, 2021 drops off. And that means you no longer can resubmit 2021 after this December. Okay. And that's how it works. So they've got a real nice chart about that. And then for your guidelines for resubmission, and the process, it's the same as submission. You just fix the things you have to fix, no matter how few, if you got 4 or if you've got 504, you just fix them and you go in and you resubmit through the platform. And you don't have to tell anybody. You very often, if you're a bank or a credit union, you're probably going to let your regulator know we're resubmitting, but they'll find out anyway because they get notices as things come through, and the CFPB knows. And it just goes in when you submit, it overrides what you had in there and it says new data. So you just use the same process, follow that. And that's really about it. So get that exam procedure for HMDA, and it's got all that data in there, and go to page 44. And it also tells you how to differentiate counting errors for race and ethnicity and everything. Those are counted a little differently. They're as a group.
Excellent. And we didn't quite get time to touch on the bank and compliance rating impact or to address questions, but we are at time. So Rachel, take us home.
All right. Thank you, everybody. Gosh, there's a lot of information to go over. Thank you for your time. Just a couple reminders. The recording will go out tomorrow. So look for that, and please fill out the survey. We'd love to get your feedback after we close out here. So with that, just happy holidays, everyone, and happy New Year.
Thank you.
Thank you so much for joining. We look forward to seeing you next time. Have a great holiday.
Thanks. Bye-bye.